There are markets like that are kind of off the radar that are going to do really, really well. If you can find a house that you really like and you can afford at today's prices, don't be scared off by the rates because they are likely to go down a little bit over the next few years. 35 million young adults between the ages of 25 and 34, biggest group in that age
Yep.
we've ever had. That's prime age for household formation and for home buying. And today's manufactured homes are nothing like the
hmm
double wides we saw in the past. These are actually pretty nice units.
Good afternoon, ladies and gentlemen. Welcome to the first webinar of the spring, since today is the first day of spring. So I wanted to welcome you all, and we are going to be talking about the housing market and what we think it's going to do this month, or sorry, this quarter. And our guest today is Rick Sharga, our friend of the company. He's been with us a couple of webinars. He did one last year for us on the spring, and he was pretty dead on. So we're going to jump right into it in a few minutes after we do some quick housekeeping rules. So we're going to go basically from the macro economy to the micro economy. And then we'll go through the Q&A session at the end. So if you have questions, go ahead and type them in the Q&A panel. We'd also ask you guys to turn off your cell phones so that you can get the full attention of Rick. And then we will be recording this and sending out both a copy of the agenda and the recording to you guys within 24 hours. So let's move real quick. For those of you, Rick, you want to do a quick introduction of yourself before I tell them about the company? For those people who don't know about you.
Sure, I'm the CEO of a company called CJ Patrick Company. We do market intelligence for firms in the real estate and financial services industries. I've been in the mortgage industry for the last 25 years or so, working for companies like Realty Track, Adam Data, Auction.com, 10X, and Carrington Mortgage Services, where Carl and I first met. So I'm delighted to be here and hope that some of the information we present today will be useful for you.
All right. And as a PR guy, I will be the first one to tell you he's also one of the most cited people in the media for his expertise. So we're really extremely happy to have him with us today. So let's go on. And quick introduction, I'm Carl Holman, Director of Communications and Content. Sorry about that. Okay, so for those people who are not familiar with A&D Mortgage, we are one of the largest non-QM lenders. We also uh, do government and conventional lending. We've been in business for almost 20 years, and we're backed up by a company called Imperial Fund, and that allows us to securitize our own originated loans on the secondary market. And that gives us a lot of flexibility when it comes to developing our own underwriting guidelines for the non-qualified mortgages. We are located nationwide. Recently, the last couple days, we've gotten our licenses for the state of Vermont and where was the other one? West Virginia. Yeah. So we're pretty much at this point nationwide, and we do predominantly wholesale lending through brokers, but we do have a small channel for both correspondent uh, and for retail, and we also service our own originated loans. Um, and if you are interested in doing business with us but don't have a license, there are 40 states where we can do business purpose only loans. So we probably can help you in most situations. Um, and with that, we will jump over to Rick's presentation and we'll open up with a couple quick questions related to the general economy, and then we'll kind of work our way through interest rates, the housing market, affordability, availability, delinquencies. So we're going to cover a wide range of stuff today. So Rick, let's talk about the current state of the economy and sort of see how it's impacting the housing sector. I mean, we keep hearing about recession and soft landings. So what's the data showing you?
Yeah, so spoiler alert, I think there's still an opportunity for the country to move into a recessionary period. at the very least, we're going to wind up seeing the economy slow down. But why don't we walk through a few of the metrics that we
Yeah.
track in the economy, and we'll see where that all goes. So the metric that most economists use as the baseline to see how the economy is doing is something called the GDP. You've probably seen it mentioned in the news. That's short for gross domestic product, and it's really the total economic output of the country. And despite all of the pessimism that we've been reading about for the last couple of years, it keeps chugging along at a pretty good rate. So the last quarter of last year, which is the most recent data we have available, it grew about 3.3%, which was much higher than most economists had forecast. And what you should know about the GDP is that about 2/3 of it, almost 70%, is made up of consumer spending. So when you see GDP numbers that are strong, it typically means that the consumer is doing pretty well in the economy. And that really is one of the reasons why economists have been baffled at just how well the economy has been performing. If you want a little bit of an inside baseball tip here, one of the reasons behind all of this is that the government injected about $15 trillion of money into the economy, a lot of which went to consumers during the COVID pandemic. And because of that, consumers have had a lot of money to spend over the years, and that's kept things going. We are doing much better than our global counterparts, by the way. If you looked at the same numbers from Canada, they barely avoided a recession, and a recession technically is 2 consecutive quarters of negative GDP growth. The UK is definitely in a recession right now. The Eurozone looks like it's heading toward a recession, and even the Chinese economy is not doing particularly well right now. So I'm saying this not to gloat about how well we're doing, but just as kind of a warning, because we are in a very interconnected global economy. And if everybody else goes into a recession, it's hard to imagine that it won't have some impact on what's going on in the US.
Mm.
One of the reasons we're seeing the economy as strong as it is that unemployment is still near historically low levels. Most economists will tell you that if you have an unemployment rate of 5% or lower, it pretty much represents full employment. And we've been spoiled for a while with really historically low levels of unemployment. Most recent number came in at about 3.9%, which again is still at the low end of things historically speaking. You see that we had a huge spike in unemployment when COVID hit. When the government shutdown occurred, we lost about 22 million jobs virtually overnight. They were almost all in the service sector: retail, restaurants, travel, tourism, hospitality, entertainment, markets like that. And we've recovered all of those jobs and more in less than 2 years. Just a remarkable recovery. One of the things I would caution you about, again, as you're seeing reports in the press, is when you hear that the government's talking about all the jobs that have been created over the last few years, keep in mind a lot of those jobs weren't really created. They were basically jobs that were vacated during the pandemic and then replaced or recovered, if you will, as the economy came back up. But nonetheless, very, very strong job reports. In fact, we still have more jobs available than we have people looking for work. So if you looked at the January jobs numbers, there were 350,000 jobs created in that month, a much higher number again than consensus was expecting. The February numbers just came out recently. They were at about 250,000, so another very strong jobs report. And we have about 8.5 million open jobs and about 6 million people looking for work. So it really is a remarkably strong jobs market. And by the way, these are not all service industry jobs. Don't get the wrong impression there. It's not just Starbucks and McDonald's that are hiring. These are construction jobs, they're manufacturing jobs, there's jobs in the trades. There's technology jobs that are going unfilled, and government jobs. There are a lot of service level jobs, service industry jobs as well, but it's across the board. And when you have more jobs available than you have people looking for work, employers need to pay more to retain or to hire employees. And because of that, wages have continued to go up pretty dramatically. The average hourly wage across the country right now is a little over $29 an hour, which is just remarkable. And wages on an annual basis have been going up between 4 and 5%. And this is so the first time in years we've been able to say that wages are going up at a faster rate than inflation. So we had wages going up pretty strongly over the last few years. but they weren't going up as rapidly as inflation was going up. So people were making more money, but it felt like they had less. And that was because of that imbalance between inflation and wage growth. And now it's flipped.
Good.
I mentioned consumer spending made up a big part of the GDP earlier. Consumer spending is still very, very strong. This is one of the charts that leads me to believe that there could be some rough times ahead. And you wouldn't know it by looking at the way the chart's set up, but because consumer spending is really great, right? Except for two things. One is that consumer spending is now disconnected from consumer confidence. So historically, that little dotted line you're looking at is consumer confidence readings. And the more confident consumers were, the more they spent. And that's particularly true for high ticket items like automobiles and housing. We saw consumer confidence and consumer spending plunge when COVID was announced, when the government shutdown occurred. Spending started to come back and consumer confidence started to come back. And then we had a second wave of COVID and a third wave of COVID. And then we had enough waves of COVID that we ran out of Greek letters. And then we had a war in Ukraine, and then we had the government just about shutting down, and now we have a war in Gaza. And consumer confidence simply hasn't come back. The concern here is that consumer confidence generally does connect with consumer spending. And now that we're through all of these stimulus funds, the worry is that consumers actually might worry themselves into less spending, which could slow down the economy pretty dramatically. And we're already starting to see in the first quarter of this year, some of the preliminary numbers coming out in things like retail spending, which are lower than estimate. So it could be that we're starting to see that slowdown. The other concern we have in this, Carl, is what kind of money consumers are spending. So the blue bars you're looking at here is consumer credit card debt. So in the third quarter of last year, for the first time ever, consumer credit card debt exceeded $1 trillion. And you can talk about inflation, the inflationary effect on the value of the dollar and anything else you want to talk about. $1 trillion is still an awful lot of money. A whole lot of zeros after that one.
Yeah, 20 and 30% interest rates.
And I'm glad you mentioned that, because while we hit record levels of consumer credit card debt, we were also seeing credit card interest rates skyrocket. The average card that was issued during this period had an interest rate of between 25 and 30%. That used to get you arrested for usury, and now it's apparently the new normal, so everybody's allowed to do it. So we do see a lot of people really tapping into credit card availability. And the flip side of that is we're seeing savings rates, personal savings rates, down near historically low numbers. The concern here is that the cost of living, even though inflation is lower than it was a year ago, the costs haven't come down. It's just that the growth rate of those costs has slowed down. So I've created my own price index. I didn't like the government's CPI, so I came up with my own. I call it the Costco price index. And what I factor into that Costco price index is the cost of salmon. So I buy my salmon at Costco. A year ago, that salmon cost $9.99 a pound. Today, it costs $12.99 a pound. That's not 3% inflation or 9% inflation. That's a 30%.
30%. Yep.
And that's what the average household is spending most of its money on, not necessarily salmon, but food, gasoline, energy, those kind of necessities. And those prices skyrocketed and have not come down. So the concern here is, are people putting those necessities on their credit cards at 25 and 30% interest? Are they tapping into personal savings to make ends meet? And this is why the Federal Reserve is so adamant about getting the cost of living down, or at least slowing the growth so that people can catch up, because they don't want this ratio of more credit card debt than savings for the average household, because that movie just doesn't end particularly well. Couple more slides, and then Carl, we can probably see if we can get the results of that quiz that we sent out to everybody. If you haven't filled it out yet, let us know what you think. But inflation does appear to have peaked. I'm showing you this chart to give you an idea how unusual what the Federal Reserve has done this time is compared to previous cycles. Not unusual for the Federal Reserve to raise the Fed funds rate to get inflation under control. But if you look at the last time it did this, and that's the shaded area to your left, you can see how they did it. It was a very measured, very methodical, step by step process. Raise the Fed funds rate a quarter point, wait and see what happens, raise it another quarter point, wait a little while. And you get to a certain point, inflation starts to come down, and you can lower the Fed funds rate. In this case, a couple things happened that kind of caught them off guard. One, they weren't expecting inflation to get as high as it did. Two, they weren't expecting it to go as high as it did as quickly as it did. And three, they underestimated how difficult it was going to be to get it back down. And so because of that, you can see how dramatically they raised the Fed funds rate and how quickly they did it. We've only ever seen something like this happen once before, or at least close to this happen once before. That was back in the 1980s when runaway inflation really was out of control. And it took a just ridiculous effort to try and get things right-sized. So you can see how quickly they raised the Fed funds rate, how high they raised the Fed funds rate. Very likely we're going to continue to see that rate at that level for the foreseeable future. And it does seem to have gotten inflation close to under control. We're now in the threes as opposed to being over 9% where we were a year ago. But most recently, we've seen the inflation numbers being a little bit stubborn, actually a little bit higher than expected. And because of that, I don't expect the Fed will cut the Fed funds rate until probably the second half of the year, maybe June at the earliest. And that has some implications for mortgage rates, which we'll get into in a couple minutes. Couple last slides, and then we'll see the poll results if they're ready. Question I get is it already too late to avoid a recession? So if you look at every time the Federal Reserve has raised the Fed funds rate to get inflation under control, going as far back as World War II, they've done it 11 times, not counting this cycle. 8 of those times they've had to overcorrect, and that's led to a recession. The 3 times that they've avoided that, and you can see the green arrows on the chart, are times where they started to adjust the Fed funds rate before inflation got too high. And so they acted proactively rather than in a reactive manner. They've already acknowledged that they waited too long this time, and because of that, they've had to raise the rates as high as they have. So they may execute a miracle here. We may avoid a recession and have a soft landing, but history suggests otherwise. History suggests they've probably already overcorrected. And in case you're wondering, there's usually a 12 to 24 month lag time between when they raise the Fed funds rates and when it really has a full impact on the economy. So that would be sometime this year in order for us to see what kind of impact those increases will have. And the other piece that I always look at historically is something called an inverted yield curve, and this really is kind of inside baseball. But basically, it's when the bonds market see a problem looming in the economy. And this typically happens when the Fed raises the Fed funds rate, which is the shortest term yield on a loan. It's the overnight payment. And what happens is the payments, the yields on short-term investments get higher than the yields on long-term investments. And that's the opposite of what you'd normally expect. If you have a 10-year bond, you would expect the yields to be higher than those on a 2-year bond because it's a longer investment. There's more risk and so forth and so on. When those two yields change places, the economists refer to that as a yield curve inversion. And the last 8 times we've had a yield curve inversion, it's been followed by a recession. The current yield curve inversion we're in today is one of the longest and deepest that we've had really in the last 50 years. And I, again, being a little bit of a history buff, I don't know that there's any reason to expect that this cycle will behave any differently than previous cycles. So that's the kind of wrap on the economy. Carl, do we have the results for the first quiz question?
I believe so. We're gonna pop those up real quick. So yeah, it looks like half of the people think we're gonna go into a soft landing, and a couple think we'll see a recession later in the year, and then some feel we're already in one. So
Yeah,
17.
that's a 50-50 split. And by the way, that's exactly what I'm getting from the economists I talk to. It's about a 50-50 split. But even so, to put it in context, the economists who don't think we're going to have a recession do think we'll see the economy slow down dramatically, almost zero growth for the year. The economists who do think we're going to have a recession have about the same kind of growth expectations for the year. But they expect the recession to be fairly short, fairly mild, and not create a huge uptick in unemployment. Maybe unemployment numbers peaking at around 5%, which, as I mentioned earlier, is about full employment. And my own research historically, says that the magic number for unemployment when it comes to the housing market is about 6%. If you go over 6% unemployment, we do start to see a definite impact on home sales and home prices. But if we stay below that, probably not so much.
Yeah, we've been below that for a good
Couple years.
couple years. So let's turn our attention over. What trends are you starting to see pop up in the housing market? What have we seen in the last year or so, and where do you see it going? Let's look in our crystal ball.
So here's the next poll question. We'll get into home prices in just a couple of minutes. But by year end, what do you think home prices are going to do here? Are they gonna fall by more than 5%, fall by less than 5%, stay flat or increase? And we'll see how your estimates compare to mine and the economists. Mortgage rates, as you're all very aware, are still near 20-year highs. And just to show how quickly things change, I pulled this snapshot on March 12th. Today is a week later. And yesterday's mortgage rates closed at 7.11%. So I believe what we're going to be seeing for the next few months is mortgage rates bouncing around somewhere between about 7.25% and 6.75%. Some weeks a little higher, some weeks a little lower, but right in that range. That's where they've been really since the beginning of the year. This is a real problem from an affordability standpoint. It's a real problem for people who'd like to sell their homes. We'll get into that in a minute. But this has had a dramatic impact on the mortgage industry and on the housing market. Probably don't have to tell you guys if you're involved in trying to issue mortgages. But I don't expect we'll see a meaningful dip in mortgage rates until the Federal Reserve actually executes its first Fed funds rate cut. When that happens, I think it'll be the sign that the market needs to start reducing mortgage rates. But until that happens, I think we're going to be in this kind of limbo phase where things are up a little and down a little. Once that happens, however, and again, I think June's probably the earliest, I do believe rates will fall steadily but slowly over the course of the rest of the year. Optimistically, we could be down to 6% or maybe a little lower than 6% by the end of the year, but not much more than that. And that will have an impact on home buying and home buying interest more than it will have on listings. We'll kind of get into that. From an overall perspective, higher mortgage rates mean that mortgage applications for purchase loans stay relatively low. So if you're looking at the orange line there, that's mortgage rates. The shaded area is the number of people that are reaching out for purchase loan applications. And you can see that as rates dipped a little bit, this is a very rate sensitive market. You saw a little bit of a spike in purchase loan applications, but we're still way off where we were back in 2022, and even a little bit below where we were in 2023. So as those mortgage rates come down, you'll see more people applying for loans, but they'll have to come down quite a bit to get us back to the kind of numbers we saw a few years ago. What this means for the mortgage industry in 2024 is that we're likely to see the overall volume, the dollar volume of loans improve a bit. The MBA is forecasting about a 22% increase in the dollar volume of loans, driven mostly by an increase in purchase loan activity. Not so much in the way of refi activity, a little better than last year, but I mean, last year was almost the lowest it's ever been since the MBA has been tracking these numbers. And for the overwhelming majority of homeowners, trying to refi into a 7% mortgage just doesn't make any financial sense.
Yeah,
so
not gonna happen.
again, the dollar volume looks a little bit better, probably more of a recovery next year than this year. And in terms of the number of loans issued, a little bit lower than that. And this should be kind of a hint at what the MBA thinks is going to happen in home sales prices. So if the number of loans goes up by 17%, but the dollar volume goes up by 22%, if you're any good at all at basic math, you can kind of figure out that the MBA is anticipating that each loan will be a little bit higher priced than it was the year before. But again, seeing a little bit of a lift this year compared to where we were last year, but nothing like where we were back in 2020 and 2021. Pending sales are lagging as well. Again, we saw a little bit of a blip up when we saw rates dip back toward the end of the year and the beginning of this year. before they jump back up into the sevens. And pending sales are contracts that are entered into, but the transaction hasn't closed yet. So a pending sale number in December or January would typically translate to a closed sale or a transaction in late January or February. So it's as close as our industry really gets to a leading indicator. All of that combines to say that December turned out to be the 28th consecutive month where we sold a lower number of existing homes than we sold the month before or the year before. So again, 28 consecutive months where we sold fewer existing homes than we did the prior year. The fallout had started to slow down by the end of the year, and with pending sales being a little stronger, and with purchase loans not being as weak as we'd seen in prior months, I was kind of hoping that January this year would be a good month. I do want to point out a couple things for you, though, on this chart real quickly before we move on. One is if you look at the blue bars, those were home sales in 2022, and we had a really weird situation in 2022 where January had the highest number of existing home sales of the entire year. Every month after that, we actually saw fewer existing homes sold. That means we basically wiped out the spring and summer selling seasons. Usually the seasonality is such that you start to see home sales increase in April, May, June, stay strong through the summer, and then decline a little bit in the fall. We never had that bump in the spring and summer selling season. It just kept getting worse. And if January hadn't been so bad last year, we would have had the same scenario play out in 2023, where just about every month you had the same or fewer homes being sold. So I'm not sure what that portends for this year's spring and summer seasons, but we're going to find out pretty soon because, as Carl pointed out, today is the first day of spring. January 2024 was a mixed bag. Existing home sales were up from December by 3%, so that's a good thing. Unfortunately, they were down compared to January a year ago, which I already mentioned was a particularly weak month. So I'm not sure where this leads us. February sales numbers should be out in the next few days, so we'll have a better idea then. But not any indication that the 2024 is going to be a booming year in terms of the number of homes sold. We had about a 3-month supply of inventory available for sale. That was only up from about 2.9 months supply. In a normal market, we'd like to see 6 months supply. So we're running at about half of the normal levels of inventory. I know there's some interest from some of the folks on the call today about when the housing shortage ends. We'll talk a little bit about housing starts in a few minutes. And the median sales price was up about 5.1% from last year. At about $379,000. The index you're looking at on the right is that pending sales index. And it was up actually month over month in January, which is a good sign. And it was up in 3 of the 4 regions, the West, the Midwest, and the South, who had increased pending home sales. The Mid-Atlantic states, the Northeast, did not. They were actually down. So generally speaking, you're looking for an index of 100. To show that it's a strong and positive housing market. So even though this month over month number was up a little bit, it's still sort of indicating a relatively weak market. By the way, we ended last year with just under 4 million existing homes being sold and about 660,000 new homes being sold. That existing home number was the lowest number of homes we've seen sold in about 25 years. So even lower than the numbers that we hit during the Great Recession. And that was strictly about inventory and affordability. So from an inventory perspective, depends on how you want to look at it. This is one of those, is the glass half full or half empty kind of charts. We're up 21% from last year in terms of the inventory of homes available for sale. That puts us at about 500,000 units available for sale. And that's good because, again, it's up 21% from last year. Unfortunately, last year was ridiculously low, and we're still at about half of the levels we would have seen back in 2019. And again, we would normally want to see about a 6-month supply of homes available. This represents about a 3-month supply. One of the reasons, by the way, Carl, that home prices have not crashed, as everybody on YouTube seems to be predicting they will. And folks, don't buy anything from anybody who's selling you a housing crash on YouTube. Save your money. Put it in penny stocks. They're a better bet. This lack of inventory is the number one reason we will not see a home price crash in 2024. What those folks don't tell you is if you go back to the housing market crash in 2008, leading up to that, we had a 13-month supply of homes available for sale.
We overbuilt. Yeah.
Way overbuilt. And so when things started to go sideways in the housing market, we had twice as many homes as the market could absorb at precisely the time, by the way, and Carl and I lived through this, when 15 million really, really bad adjustable rate mortgages all came due to reset at
Yep.
rates that people couldn't afford. So they mailed the keys back to the bank. Everybody went into foreclosure. It was a perfect storm. And none of those dynamics is in play today. You can see that where there is new inventory, it's kind of the bluish greenish areas. Most of it is in the South and Midwest. The areas on the coasts, by and large, with the exception of Florida, are at much lower inventory levels than they were back in January 2019. And by the way, these slides will all be made available to you. They'll be mailed out to everybody at the end of or after today's webinar. So you don't have to take too copious notes as we go through this. But this should just give you an idea. And one of the reasons, by the way, we're seeing more inventory in the Midwest and the South is that that's where people are moving. We're still seeing a migration from the high cost, high tax areas. California lost about 300,000 people last year in net. So 300,000 more people left than came. Illinois and New York both lost about 100,000 each. Everybody moved to become Carl's neighbor in Florida, apparently. Although interestingly, we also saw migration out of South Florida into the northern and central parts of the state. So anywhere where you see that combination of really high home prices, really high cost of living, and in some cases high taxes, we're seeing people move toward the middle of the country and toward the southern states to be able to afford to buy a house or have a lower cost of living. The reason we're seeing the inventory numbers come up is not entirely due to new listings, unfortunately. In fact, I just saw an update on this chart last night. And if you saw that, you see that dark red line there, which is 2024 listings, it flattened out this week. So it's not rising anymore, it's flattening. So remember I told you inventory was up 21% from last year. New listings are up 15%. So that's interesting growth. But what it tells you is there's another reason the inventory numbers are up besides new listings. And that reason is it's simply taking a little longer to sell those properties once they hit the market. So they stay in the inventory numbers longer. So 2024 in terms of new listings, in terms of inventory, is looking better than 2023, but it's below where we've been in almost every year for the last 10 years or so at this time of year, but at least moving in the right direction. There's a reason people are not listing their homes for sale. The reason is they simply can't afford to. And this is what I was talking about with those high interest rates being very, very difficult for people who would like to sell their homes. Over 2/3 of homeowners with a mortgage have an interest rate on their mortgage of 4% or less. 90% have an interest rate of 6% or less. But if you're in that 2/3, that 67% of all homeowners who have a mortgage rate, let's say of 3%, and you sell your house and buy a new one at exactly the same price as the one you sold, get a new mortgage at today's rates, you've more than doubled your monthly payment. And most people simply can't afford to do that. There will always be people who need to list their house. There are people who get married, people who get divorced, people who get a new job that requires a transfer, people that lose a job, where there's a death in the family, where there's a birth in the family. So those are the kind of homeowners where you'll see those listings. People that find themselves in financial distress and get that first foreclosure notice and need to move. So you will see those people come to market. But the people who have a choice, by and large, are choosing to stay put. And I mentioned divorce, and Carl, one of the things I just saw, I forget if it was New York Times or Wall Street Journal, but there was an article about a growing trend of divorced couples to stay in the house that they own together after the divorce because they can't afford to sell it and buy a new house.
Good Lord.
And yeah, can you imagine those households? But that's how crazy things have gotten. And the economists that I speak with believe the inflection point where mortgage rates have to get to allow these people to kind of get over the hump and sell their house is when mortgage rates get below 5.5%. That's probably not likely to happen until 2025. So the number of new listings coming to market is going to continue to be constrained a bit simply by these numbers. This is the other reason, the higher mortgage rates, the other reason a lot of the prognosticators on YouTube are talking about a housing price crash. Well, prices are too high. Nobody can afford to buy a house. So therefore, home prices have to come down 20 and 30%. Except I'd like you to go find the homeowners who are going to voluntarily take 20 to 30% less selling their house than they have to.
No.
They're just not, again, unless they absolutely have to do that, they're not going to do that. And by and large, by the way, they don't have to. If you look at list price reductions across the country, they're right about where they are in an average year. And the list price reduction usually is on average about 1 to 3%. So it's not a huge drop. So what's going to happen as mortgage rates do gradually come down this year is it's going to make the market much more attractive for buyers. They're very rate sensitive. They're going to come to market. There's going to be more of them. We're not going to see as many listings come to market as we would like. And so they're going to be bidding against each other, and very likely that's going to cause prices to go up rather than down. So again, be careful what you believe on YouTube. And in fact, if you look at prices at the end of 2023, this is data from the FHFA. That's the governing body that controls Fannie Mae and Freddie Mac. So all of those 30-year fixed rate conventional loans, which make up most of the market outside of what Carl will get you from A&D Mortgage, those prices have gone up year over year, 6.5%. In every region across the country, they're up. If I'd shared this chart with you a few months ago, you would have seen the Pacific and mountain regions were both in negative territory. But after June, which is when prices for last year pretty much bottomed out, they've been coming back. And at the end of this year, every region in the country was reporting a year over year increase in prices. And that's true whether you're looking at FHFA numbers or Case-Shiller or Freddie Mac or the National Association of Realtors. Everybody's numbers were up. Now, prices do vary wildly and widely within those individual regions. And again, it kind of depends on what's going on in your local market. So keep that in mind. This is something that Resi Club pulled together from Zillow's Home Value Index. No seasonal adjustments. So the numbers I just showed you were on same property sales. This is based sort of on Zillow's estimations, but you can see that home prices, absent of just being in the sales area, vary all over the place. And some of the formerly high-flying markets, the markets that soared after COVID, Boise, Idaho, Austin, Texas, Phoenix, Arizona, Las Vegas, Salt Lake City, Utah. Some of these markets have seen prices claw back a bit from those abnormally high prices that they saw coming out of COVID. But it's really important, and whether you agree with these numbers from Zillow or not, the reason I'm sharing this with you is just to point out that you really do need to be paying attention to what's going on in your local market, because conditions are going to vary. And what I tell realtors and investors and lenders is, take a look at non-housing metrics. Take a look at population growth, take a look at job growth, take a look at wage growth within your market. And if you have positive numbers in all three of those, you're likely to have a very strong housing market. New home inventory, by the way, the new home sales are doing better than existing home sales, relatively speaking. In a normal year, about 10 to 15% of sales are new home sales. At the end of last year, it was almost 30%. One of the reasons is simply because new homes are available. So new home inventory is back almost to pre-pandemic levels. So in the existing home market, normally you want to see about a 6-month supply. In the new home market, there's usually about a 7-month supply. And that's pretty much where we are right now. The color breakout in this chart, the red area is new homes that are completed. The construction is done. They're ready to be moved into. The blue homes are homes that are under construction. And the green area is really permits or land that's been cleared, but the construction hasn't started yet. And all of these are trending in the right direction. We did see that new home sales ended the year on an uptick. As I said, I think we finished last year with about 660,000 new homes being sold. And the inventory, as I mentioned, is right around a 7 or even 8-month supply. One of the other reasons new homes have been selling is they've been more affordable. So new home prices are down about 15% from peak. And this might be important if you're talking to borrowers who are interested in buying a house. This is not, by the way, because the builders are discounting last year's inventory. They've started to build slightly smaller homes. They started to build homes where perhaps the fixtures aren't quite as expensive. And they've done this to get prices down to accommodate for these higher financing costs. And it's really made a demonstrable difference. If you look at the median price of an existing home being sold compared to the median price of a new home, the spread is as narrow as I've seen in the last 20 years.
Yeah, and
So
supply chain issues have kind of cleared themselves up.
yeah, a year ago, Carl, we had an all-time record of the number of new homes under construction, and that wasn't because the builders were anxious to get to market. It's because they couldn't get parts, couldn't get appliances, couldn't get roofing tiles. It
Get
was a
wood.
mess. That's pretty much cleared up, and so
Yeah.
they're building new, smaller homes, less expensive homes. And the other thing they're doing, which is brilliant, is they are coming to closing with thousands and sometimes tens of thousands of dollars in cash and paying down points to get mortgage rates down. I was speaking to a group in Denver not too long ago. I saw a billboard in town from a builder who was advertising 4.9% mortgage rates. So imagine being a buyer in today's market, having a choice between a new home and an existing home that's almost the same price. And you can get the new home with a 4.9% mortgage as opposed to a 7% mortgage.
Yep, and a builder's warranty.
And a builder's warranty. So yeah, we would be selling many more new homes if the builders would build more new homes. They are starting to. Housing starts and permits, you probably read headlines that said housing starts were down year over year. You got to read the fine print sometimes. That was a head fake from the media, not on purpose, but bad news sells, right? So what really happened was multifamily housing starts were down. They were down about 39% in January. And the reason for that is because we have a record number of apartment units coming online now. So they don't really need to be building more apartments at the moment. But if you looked at owner-occupied single-family residential units being built, they were actually up 8.8% year over year in January. And the February numbers came out this morning. And single-family housing starts were up over 30% from a year ago. To the tune of something like an annualized number of between 1.5 and 1.6 million. So the builders are coming back. They're not going to overbuild because, as Carl mentioned, they overbuilt during the Great Recession period. But they are coming online and they are starting to fill in some of the gaps that we really need in order to get the kind of housing supply necessary. Now, the logical question you should be, and by the way, the permit numbers came in higher as well in February. So not only are they starting to build more, but they are planning to build even more going forward. That will not all happen equally across the country. So check your local market for more information. If you're in California, for example, don't expect to see a boom of new home development because the state makes it just about impossible to get anything started that doesn't take 3 or 4 years just to get through the permitting process. Completely lost my train of thought there. But we are starting to see that recovery in terms of filling that gap between the housing stock that we need and the housing stock that we have. So, the one area where we will not see a lot of new home building is in the entry-level housing market. Builders are building, even though the properties are a little smaller, a little less expensive, they're still not really entry-level properties in most markets because the builders make more money on more expensive properties. What that does mean, though, is it should provide move-up opportunities for people who are ready to get that bigger house, and that should open up some entry-level inventory for your starters. I think now might be a good time to see what people think about home prices, Carl.
Yep. All right, what do you think? Well, we think that they're going to fall, but by 5%. No, oops.
Yeah.
We got a tie between stay flat and fall, but less than 5%, and some think it'll go up a little bit.
So consensus among most economists, and I participate in a survey that goes out from Fannie Mae every quarter on price increases. The consensus is that prices will probably go up in the low single digits this year, somewhere between 3 and 5% between now and the end of the year. Almost none of the economists that I talked to are predicting a price decline nationally. Now, again, local results will vary. If you're in Austin, if you're in Seattle, you might continue to see prices claw back a little bit. But on the other hand, if you're in Pensacola or if you're in Nashville or Raleigh, you're likely to see prices go up a little bit. So, but the belief is that we won't have enough inventory coming to market to meet the growing demand, and because of that, we'll see more price competition for homes, and prices will go up a little bit, particularly as mortgage rates come down. What's going on with investors? And I know, Carl, you guys do some lending on the private in the private side, the business purpose loans.
Yep.
We are continuing. I think I jumped over a slide there. We are continuing to see the share of home purchases made by investors continue to grow. This is data from CoreLogic. These records tend to lag a few months, but as we got into the third quarter or through the third quarter of last year, investors represented somewhere between 25 and 30% of all home purchases. And I believe these numbers were actually understated a little bit, because the way CoreLogic accounts investor purchase is any purchase that's made by an entity with a business designation in their name. So an Inc., an LLC, an LP, a Corp, anything like that that buys a property gets lumped in here. But it doesn't necessarily count those individual investors who don't have a business entity that they use to buy these properties, but at least 26 to 30%. Now, keep in mind that there are fewer consumers buying homes right now. So this doesn't necessarily mean there's more investors coming into the market, just that their share of market is a little bit higher. But if you're a lender, if you're a realtor in this market and you're not working with investors, that means you're missing out on somewhere between a quarter and a third of all transactions. And these are people who tend to be frequent customers. So you really should be looking at this. And also of interest, particularly for mortgage brokers, for realtors, is most of this growth is not from large institutional investors. It's from small and mid-sized investors. These are your mom and pops who own 5 to 10 properties, looking to buy property number 6. These are your mid-sized investors who own a few dozen properties, maybe 100. This is not Blackstone. This is not American Homes for Rent. This is not Starwood. Those folks have been keeping their powder dry, and collectively they represent a very small percentage of the market. So keep that in mind as you're looking at market dynamics and looking at potential customers. Fix and flip investing has dropped pretty significantly. We're down about 30% from the same quarter in 2022, according to the flipping report from Adam. We were down to about 70,000 flips in the third quarter of last year. That's the lowest number in years. And it's been a tough market for flippers because prices have gone up since they bought the properties. They haven't been able to mark the properties up as high as they need to because interest rates on loans has also gone up. So their buyers can't afford to buy. I've known some very seasoned, very smart flippers who've been losing money on their deals over the last year as they just happen to get caught at the wrong time in the market. The good news for flippers is we've started to see those gross margins improve. And Adam's numbers, when they look at gross margins, are really just looking at what did you buy the property for and what did you sell the property for. So it's not factoring in construction costs or remodeling costs, labor costs, insurance, any of those things, but just dollars out versus dollars in. We've had 3 consecutive quarters now where those numbers have improved. So we may have bottomed out in terms of the number of flips being done. Again, tough combination of pricing dynamics and limited inventory for flippers. But when they can find properties now, it appears that they're able to sell them at a better price. On the other hand, if you're looking at rental property investments on the apartment side, we've seen apartment rents flatten out. They've actually gone negative in some markets. This shows you what the asking rents are for new tenants from RealPage, and they peaked over 15% back in 2022 when vacancy rates in apartments was at an all-time low. The occupancy rates were at something like 98% nationally, which is just crazy. But nobody was moving because of COVID, and people were looking for places to live. As we've seen these apartments come online, we've seen more inventory come to market. We've seen people moving out. And so we've seen the asking prices come down pretty significantly. The good news, if you're looking at financing or buying a single family property to rent out, is those rents have stayed positive. So even though your year over year asking increases are somewhere in the 2.5% to 3% range, they're still positive. And that's coming off that's on top of what the rent asking prices were a year ago. So better dynamics if you're looking at those single family properties. And what I would suggest to those of you who either are or working with investors is There are probably several million people who would like to be homeowners right now, would like to live in a certain school district. Maybe they have a growing family, they need to get out of an apartment, but they simply can't afford to buy a house at today's rates. These are people who probably rather rent a house than rent an apartment. And so there are probably, several million opportunities out there for those of you who are in the single family rental space that are going to stay legitimate opportunities for the next couple of years while we see mortgage rates stay higher than what we would like. We're going to get into delinquencies and foreclosures, and I believe there's another polling question we can fire up here.
Yep.
So what do we think is going to happen with foreclosure and delinquency activities across the country this year? Vote early and often, as they say in Chicago, and we'll see the results as we get through this section. Carl?
Yep.
So what are we seeing? I mentioned the strength of the consumer earlier. I mentioned some concerns about credit card spending. This is another area of concern. Delinquencies among consumers are increasing really in just about every category of consumer credit. So whether you're looking at auto loans, which really have spiked pretty significantly, whether you're looking at credit card delinquency rates, whether you're looking at consumer loans, even mortgages are going up a little bit, but the consumer credit cards, consumer loans, auto loans are all up now at delinquency rates that are higher than they were prior to the pandemic. The one area that has not done that yet, and I say yet on purpose, is student loans. And the reason I believe we haven't seen that increase yet is that people only recently needed to start making student loan payments again.
Yep.
So I don't think there's been time for them to go delinquent. But this is one of those red flags as you look at across the future with the economy. Are we starting to see signs of consumers weakening as we move forward? We did see mortgage delinquency rates rise a little bit in the fourth quarter, according to the Mortgage Bankers Association. But as you can see, if you look at that, where we are in the far right-hand side of the chart compared to historic levels, we're still a little bit below normal. And the blue area is, early stage delinquencies, mostly 30-day delinquencies. And that's the overwhelming majority of mortgage delinquencies right now. And most of those are not rolling over into later stage delinquencies, and most of those are not rolling into foreclosures. So we have about a 3.8% delinquency rate on mortgages. The historic average is somewhere between 4 and 5%. So we're below normal levels of delinquency rates. And because we're below those normal levels of delinquency rates, you can see it across the board. There's one area where we have an area of concern. Those are FHA loans. You're looking at delinquency rates there of about 11% compared to the overall average of 3.8%. Conventional loans, which are the majority of loans, are well below that. But because there aren't that many delinquencies and fewer of those are rolling into foreclosure, you're seeing fewer foreclosures. So this is some interesting data pulled together by my friend Darren Bloomquist over at auction.com. And interestingly enough, we actually have slightly more loans that are 30 days and more delinquent in the third quarter of last year than we did at the end of 2019. But as you see, as they go through the funnel, we have fewer of those going to serious delinquency of 90 days delinquent or into foreclosure. We have far fewer of them going into foreclosure, about 10% fewer foreclosure starts, and far fewer of them going to foreclosure auction. So something's happening between when they go delinquent and what would normally be a regular progression going into those foreclosure sales. Another way of looking at it, again, keep this in mind. I've seen a few headlines recently about foreclosure rates climbing. This is what the climb looks like. It ain't much of a climb, folks. It's not a mountain, it's barely a hill. So last year, overall foreclosure activity was up about 10% from 2022. We're still about 30% lower than what we were back in 2019. And by the way, 2019 was not a particularly big year in terms of foreclosure activity. So the loan quality since the end of the Great Recession has been extraordinarily strong. Mortgage delinquency rates usually run hand in hand with unemployment rates. So if you remember, I said we had about a 3.9% unemployment rate. We have about a 3.88% mortgage delinquency rate. And if you don't have a lot of delinquent mortgages, you're not going to have a lot of foreclosures. And that's really what we're seeing here. I don't expect foreclosure activity to be back to 2019 levels until sometime next year. But we are seeing a difference in the stages of foreclosure. So we're seeing about 80 to 85% as many borrowers get that first foreclosure notice as they were in 2019, but only half as many get as far as the foreclosure sale. And only about a third as many are going back to the banks as REO properties. And that's because the majority of distressed borrowers still have a lot of equity. And this really just depends on whose numbers you look at. This is numbers from Black Knight, which is now owned by A&D Mortgage Technology. But if you look at this data, if you look at data from Adam, what we're seeing is that the majority of something like 90% of borrowers in foreclosure have positive equity in their homes. And what they're doing is tapping into that equity. They're protecting that equity by selling their homes before the foreclosure auction takes place. So if you go back to the Great Recession when everybody was underwater on their loans, they had no incentive to sell the property because they'd wind up selling it for less than they owed on the mortgage. They were probably going to get hit with by the lender for that difference. So they just rode out the foreclosure until the sale and until they got evicted, and basically just decided they'd save the money they would have paid on the mortgage monthly. This is not the case this time. So if you're sitting on 20, 30, 40% equity, which a lot of these borrowers are, rather than lose all of it to a foreclosure auction, they are selling the property prior to that foreclosure sale and pocketing the equity. So 55% of distress sales in this most recent report, and I was talking to Darren about this just yesterday, he said it's somewhere between 55 and 65% every month of these distressed borrowers are selling their homes prior to the auction. That leaves fewer properties going to auction and fewer properties available as REOs. So again, if you're an agent looking to sell these kind of REO properties, not really the dynamic we're seeing in today's market.
Yep.
Before we get into this commercial side of delinquency, why don't we take a look at the poll results for foreclosure activity?
Sure. Yep. Oh, so vast majority think it'll increase, but remain below the recession, which is what you're saying, and then it should stay below the pre-pandemic. So it's not always not as doom and gloom as we all think. Yep.
The one exception to this rule is probably going to be in the commercial market. Commercial market, we're seeing delinquencies go up really across the board, whether it's multifamily, retail, industrial, hotels, or other types of commercial properties. Now, again, if you look at the biggest spikes here, they almost always occurred during the Great Recession, so we're not back to those levels, but the delinquency rates have been going up. The one exception, again, is the office space. All the way on the left, their delinquency rates now are much higher than they were even during the Great Recession. And the work from home environment has really wreaked havoc in this industry. Now, just a warning for you again, not to pay close attention to national headlines. The office market is not homogeneous. So you're going to have different delinquency rates and different vacancy rates in different types of markets. If you're in San Francisco, Los Angeles, New York, Seattle, probably Chicago, maybe Boston, you're seeing the central business districts with very high delinquency rates in some of those office towers. Although interestingly, the Class A buildings are doing very well. It's the B and C ones that are having trouble. But in San Francisco, not unusual to see a building with 40, 50% delinquency rates. On the other hand, if you're in secondary, tertiary markets, smaller markets, if you're in suburban areas, the vacancy rates aren't nearly that bad. And the banks that everybody's worried about going under because of their high commercial exposure, for the most part, their exposure is in those secondary markets and those suburban markets. Really, the investors that have most of the exposure to the bigger markets are insurance companies, institutional investors, hedge funds, and the like. But there is a lot of commercial distress. You can see there's about $35 billion in loans that are in distress in the commercial market. In the office space, about $22 billion in retail, and so forth and so on. And you can see cumulatively, we're looking at probably about $75 billion that's either already been repossessed or is in some stage of distress. So almost 4% of commercial sales are now in distress. Not a big number compared to the Great Recession, but the biggest number we've seen in a number of years. And the number of commercial foreclosures is much higher than usual. I'm hesitant to give out this chart because I'm afraid somebody on YouTube is going to use it for evil purposes. Look at the chart closely, because what you'll see is while that number is spiking on the right, it's still right around 700 foreclosure actions a month. So we're not talking about tens of thousands of properties going into foreclosure. The rate of activity is 2 to 3 times higher, but it's not a huge number of these properties going into foreclosure. But if you're looking for distressed buying opportunities, that's probably where they're going to be. So just to kind of recap what we talked about, and then Carl, if there's any questions, we'd spend
Yeah, we've got a few.
I believe a short, mild recession still seems to be at least a possibility, but with unemployment probably not going much higher than 5%, even if we have one. If we don't have a recession, we'll at least see the economy slow down pretty significantly. I'm expecting to see home sales volume bounce up a little bit. I think last year was the bottom. I would be surprised if we saw existing home sales go much higher than 4.5 million. Would not be surprised if we see more than 700,000 new homes sold. Really just depends on how quickly the builders build. The mortgage rates going up is going to bring more buyers than sellers to the market, which is going to make prices go up. If you're a mortgage broker, you may want to be taking a look at non-traditional products right now. In addition to the non-QM loans that Carl mentioned earlier, HELOCs, home equity loans, things like that, because there's just not going to be a ton of traditional refi activity and again, limited growth in the purchase market. Investor share is going to probably remain unusually high. So if you're not working with investors, you should be. Commercial sales are likely to decline in the first half of this year. The market's still kind of figuring out what prices should be on properties. And until we get to that price certainty, probably later this year, you're not going to see a huge increase in commercial sales. And then foreclosure activity is going to remain below normal levels throughout the rest of this year. REO inventory may not come back for a few years. So that's where I see things going. Appreciate the opportunity, Carl, to join you today and
Sure.
be part of this A&D Mortgage event. And I'll stop sharing my screen so that we can have a conversation.
Yeah, we've got a couple questions from some of the audience members. You've kind of covered this bits and pieces, but what do you think? When do you think the housing shortage is going to end?
It's a time issue, Carl. I think we're years away from that. There's 35 million young adults between the ages of 25 and 34, biggest group in that age
Yep.
we've ever had. That's prime age for household formation and for home buying. So we're probably at least another 5 years away from being out of the housing shortage. One of the things that could address that, by the way, we're starting to see the government agencies, FHA, Fannie, Freddie, get more tolerant about financing for manufactured housing. And today's manufactured homes are nothing like the double wides we saw in the past. These are actually pretty nice units. So we could see some manufactured housing start to nibble away at some of the shortage we have. But left to its own devices, we're probably looking at another 5 years.
All right, and then we've looked at the numbers, but what are your thoughts on just how home prices as they are and the affordability in general?
Affordability was near an all-time low last year. I think rather than seeing home prices crash, we're going to see something that we've seen in the 80s, something we saw in the 90s, which is that as the market resets at these newer high financing costs, we're going to see 2 or 3 years of really sluggish housing sales. So we're going to see home sales go up a little bit year over year, the number of homes. We're going to see home prices go up, but only a little bit year over year. Right now, home prices are going up about the same rate as inflation. And it takes 3-4 years for the housing market to reset at these new levels. And that's really kind of where I see the market going this year, is modest increase in the number of homes sold, a modest increase in prices.
Yeah. And you had shown us a couple of charts, I think during the default section. Were there any areas that were particularly affected? West Coast, Middle, South, Northeast?
I think we still see that migration from some of the higher cost markets. Now, if you're in California, sometimes the migration is from the coast to the inland areas, which are less expensive, or from the south to the far north. But I do think we're going to continue to see more price growth and more population growth in the South and Southeast. We will see a little bit of increased activity in the Midwest. If you want my bracket pick for the Cinderella story, the underdog coming through the NCAA tournament of the housing market, it's Columbus, Ohio, which has been one of the great unknowns in the housing market for the last few years, but performing extraordinarily well. Big market for medical and healthcare jobs. It is the home of the only university in the country I'm aware of that actually has a participle as part of its formal name, and the Ohio State University. And Intel has announced that they're going to be building a fabrication plant for processors, microprocessors in the vicinity. So there are markets like that that are kind of off the radar that are going to do really well. I think it's going to take a little longer for some of the bigger, more established markets to fully recover.
Mm. We have somebody that's thinking about buying a house in May, but they're a little hesitant because the rates are floating around 7%. Do you want to look in your crystal ball and tell them if they should wait or not?
Yeah, don't take personal investment advice from me, please. This is not intended as such. What I will tell you though is if you can find a house that you really like and you can afford at today's prices, don't be scared off by the rates because they are likely to go down a little bit over the next few years. If you're overreaching to buy that house, then I would wait until you're actually ready financially to do it. But if you can afford it, the difference between buying that house and waiting is that the home prices are likely to keep going up. You have to take your calculator out and figure out if prices go up 5% and mortgage rates come down by a point, are you better off waiting a year or not? And that's something you have to figure out on your own. But do a full financial assessment. Make sure you take a look at property taxes. Make sure you look at insurance because if you're in certain parts of the country, your insurance rates, California, Florida, Texas, I'm looking at you, have doubled and sometimes tripled in the last couple of years. So do the math, but don't be afraid if it's something you can afford today because it means you'll probably be able to afford it going forward.
Yeah, and the last question actually is a going forward, which is where do you see things 5 years from now or going for the next 5 years? We've kind of touched on a couple of long-term trends.
Yeah, certain Asian cultures do 500-year plans. I envy that. I'm not sure how exactly they do that. I'm reluctant to go out 5 years, but our population continues to grow. Our population continues to age. We are a country that does benefit more from legal immigration, people coming into the country and growing the economy. So I'm bullish long term on the housing market. Do I think we're going to get there in a straight line growth? No, we'll probably have some starts and stops along the way. It'd be really unusual over a 5-year period not to have a couple hiccups, a couple speed bumps. But this should tell you, Carl, that I desperately need a better hobby. But I've tracked housing prices over the last 100 years. And during that period, we've only ever had one time when home prices went down 20% and stuck there. And that was during the Great Recession. So you get this kind of sawtooth growth, going from down to up over time. So again, prices don't always go up in a straight line, but over time they tend to go up and the number of homes being sold tends to go up as well.
Okay. All right. Well, we don't have any other additional questions that have come in, so I'll just do the quick wrap up for the audience and let them know what's coming down. All right. So thank you guys for being patient and staying with us a few extra minutes longer. So really quickly, if you're not doing business with us, one of our key messages is that we're your partner for growth. And we do that through our 4 major pillars, which is our streamlined loan process, which is we basically have developed a process that will hopefully get you to the closing as fast as you can. We have expert account executives and underwriters and closers that'll take care of getting everything ready for you. And we're always about the power of yes. So we're trying to get you again to the closing as fast as we can. And then the other 2 tenants really are, again, tying back to our relationship with Imperial Fund that allows us to both be flexible in our underwriting on the non-QM side and also be smart in our research and monitoring through, webinars like yours and seeing what's coming down the pipeline to be able to develop loan programs that will be flexible enough as well to adapt to the market and where we think things are going. And broker education is a pretty critical component of what we do. So we're going to look at a kind of niche topic in our next webinar next week on looking at 1031 exchanges as an opportunity for people to find some potential business. So we will encourage you guys to join us if you're looking for some unique ways to find borrowers. And then we'll just close it out with the last other 2 webinars that we've got coming up, which is our broker orientation. That's our regular monthly overview of working with the company and our loan products and our processes. It's traditionally targeted for new brokers who've just been approved with us, but we welcome it for potential prospect brokers if they're sort of still curious, even after this first webinar, about whether they would want to partner with us. And then later in April, we're going to be making some technology announcements about some things that we've been working on for a few months and that we'll be getting ready to release to the public. So we're going to do a deep dive into those platforms at the end of the month. And so I would also encourage you, again, if you're not a partner, you can scan the QR code or go to our website. There's a big old button, become a partner. You can find it on every page. So we'd encourage you to join up with us. So with that, I'm going to close this out. Rick, as always, it's good to see you. Good to see you. Great information. We always have a good time. I think you as I said when I first met you years ago, you're one of the smartest guys I've ever met. You still continue to be. So we appreciate your insights, and hopefully it helps our brokers do business more during the spring. So
Thanks for having me, Carl.
yeah, appreciate it. So if you guys can just stick around for a minute or 2 after and just take a brief survey and let us know how we did. Again, sorry if we're running a few minutes late, but we appreciate it. So with that, thanks everybody.